Ladies and gentlemen, let me ask you a question the financial media will never ask. What if the price of silver is not low because there's too much of it, but because the system cannot survive if it rises? What if Bank of America didn't just make a trade, but quietly raised a white flag? Because when a US megabank signals $309 silver, that's not optimism, that's panic, that's not analysis, that's an alert. And here's the part they don't want you thinking about. Silver didn't move, inflation didn't spike overnight, demand didn't suddenly appear. So why did Bank of America, one of the most systemically important banks on earth, break the unspoken rule? Because there is an unspoken rule. You never tell the public the truth about metals, not gold, not silver, not the one asset that exposes the lie underneath fiat money. Now ask yourself this: why does your grocery bill keep rising? Why does your rent feel heavier every year? Why do wages fall behind while asset prices soar? It's not incompetence, it's design. And silver, small, industrial, ignored silver, sits right at the center of the deception. Quick check-in before we go deeper. Where are you watching from right now? Drop your city or country in the comments. This channel is a global audit, and if you want the unfiltered truth, not CNBC truth, not Wall Street truth, hit subscribe now, because what you're about to hear will never trend on financial television. Now let's rewind. Because this story didn't start with Bank of America. It started decades ago. With a lie so profitable, it became permanent. To understand why Bank of America's silver alert matters, you need to understand one brutal truth. Silver has always been suppressed because it exposes debt. For thousands of years, silver wasn't an investment, it was money. Empires didn't collapse because they ran out of soldiers. They collapsed because they ran out of honest currency. Rome debased silver, Spain flooded Europe with it, Britain abandoned it. Every time, the same pattern. Governments overspend, debts explode, currency loses trust, precious metals reveal the damage. Sound familiar? By the early 20th century, silver still threatened governments because it limited how much debt they could issue, so they removed it. First slowly, then permanently. In 1965, the United States quietly removed silver from circulating coinage. Official reason? Rising costs. Real reason? The government was printing faster than silver could cover. Sound familiar? From that moment on, silver was no longer money. It became a commodity. And once something becomes a commodity, it can be financialized. That's when the real game began. In the 1970s and 80s, banks discovered something revolutionary. You don't need silver to sell silver. You only need contracts, futures, swaps, options, unallocated accounts. They built a market where 1 ounce of physical silver backed 100, then 200, then 400 paper claims. Nobody complained because nobody asked for delivery. Why would they? The price was stable. Volatility was controlled. The illusion worked. Sound familiar? This is the same model used in mortgage-backed securities, credit default swaps, repo markets, ETFs. Everything is liquid until it isn't. Banks like JP Morgan, HSBC, Scotia, Bank of America were not just participants, they were market makers. They didn't trade silver, they controlled perception. They learned a critical lesson. If you control futures pricing, you control the headline price, even if physical demand explodes. So silver could be scarce while the price stayed low. A perfect scam until physical demand returned. After 2020, everything changed. Stimulus, trillions printed, rates pinned to zero. Retail investors started asking uncomfortable questions. Why is silver used in solar, EVs, weapons, and medicine, yet priced like junk? Why do coin shops have shortages when COMEX says plenty? Why are premiums rising while spot prices fall? Sound familiar? This is exactly what happens before every market rupture. The official price says one thing, reality says another, and then Bank of America speaks. This is not a Reddit trader, not a YouTuber, not a prepper. This is a systemic bank, one that clears derivatives, one that touches sovereign debt, one that cannot afford to be wrong. When BofA hints at $309 silver, they are not predicting price. They are signaling stress. Stress in, physical availability, counterparty risk, derivatives exposure, industrial demand, ETF redemption pressure. This is the same playbook we saw in 2007 subprime, 2019 repo crisis, 2023 regional bank failures. The warnings always come coded, and silver just sent one. If silver is abundant, why are physical premiums exploding? If silver is irrelevant, why do banks trade trillions in derivatives tied to it? If silver is dead, why are central banks and militaries hoarding it indirectly through supply chains? The answer is simple. Silver isn't scarce. Honest pricing is. And that brings us to the moment everything breaks. Because next, we expose the mechanism, the one decision, the one structure, the one name. And trust me, you won't believe the name. Up to this point, everything you've heard still fits inside a familiar frame. Banks manipulate markets, governments overspend, precious metals get suppressed. That alone is disturbing, but now we cross the line from corruption into structural inevitability, because what's coming next isn't about intent anymore. It's about math, and math doesn't care about excuses. Here's the first twist. Silver is no longer priced as a metal. It is priced as a liability. That's not rhetoric, that's accounting. Inside the global financial system, silver exists mostly as futures contracts, OTC swaps, ETF units, unallocated pool accounts. These are not assets, they are promises. Promises to deliver silver later, if requested, under conditions that assume most people never ask. The entire system relies on non-delivery. Now ask yourself, what happens if delivery demand rises even slightly? Not 50%, not 20%, not a run, just a few percent? The answer is catastrophic, because the system is leveraged beyond comprehension. In banking, there's a term you're never supposed to hear discussed publicly: fractional reserve leverage. Most people understand it with banks and deposits, but almost nobody realizes it exists in commodities. In silver, estimates from independent audits, whistleblowers, and court records suggest this ratio has reached anywhere between 101 to 401. That means for every 1 ounce of physical silver available for delivery, there are hundreds of paper claims. Hundreds. If even 1% of holders demand delivery, the system fails. Not tight, not stressed. Fails. Default. Force majeure. Cash settlement. Game over. And here's the twist. Bank of America is one of the largest counterparties in this structure. Now, many viewers immediately think, JP Morgan has the silver. True, partially. JPM is the warehouse king, the vault holder, the visible giant. But Bank of America plays a different role. BofA is a derivatives clearing conduit. They sit between producers, refiners, industrial buyers, hedge funds, ETFs. They are not holding silver. They are guaranteeing performance, which means when someone fails, BofA pays. This is the same role AIG played in 2008, and we all remember how that ended. This is the key moment you must understand. When Bank of America signals $390 silver, they are not saying silver will rise because demand is strong. They are saying, if the paper market breaks, this is what reconciliation looks like. $390 is not upside. It is damage control math. It is the price required to incentivize emergency physical supply, offset derivative losses, force cash settlement without total collapse, maintain confidence just long enough. That number doesn't come from charts. It comes from exposure models, from internal stress tests, from what-if scenarios nobody was supposed to see. And that's why this is so dangerous, because it means those scenarios are no longer theoretical. Why now? Why say anything at all? Banks don't warn the public unless silence is more dangerous than disclosure. That tells us one thing. Pressure has already crossed an internal threshold. Something changed. And here's where the story gets darker. Silver is no longer optional. It is embedded. Solar panels, EVs, military electronics, medical equipment, data centers, AI infrastructure. Unlike gold, silver is consumed, gone forever. Every year, more silver is used than mined. For the first time in modern history, inventories are shrinking while usage accelerates. This creates a trap, because derivatives assume silver can always be sourced later. But industry doesn't wait. When industry competes with investors for physical metal, the paper market breaks first. Now, here's the part the mainstream absolutely refuses to explain. In almost every silver contract, buried deep in the language is a clause, cash settlement at issuer's discretion. Translation, if silver cannot be delivered, you don't get silver, you get dollars at their price, not the real price. This is not protection for you, it is protection for them. And once that clause is triggered at scale, silver stops being a market. It becomes a liability event. This brings us back to Bank of America. If BofA is signaling $309, it means they are modeling a world where physical silver fails to clear, cash settlement becomes widespread, trust evaporates, premiums disconnect permanently from spot. Industrial users panic by supply. Retail gets locked out. That is not a rally, that is a reset. And now comes the moment that changes how you see everything. Because the architect of this system, the designer of the silver paper illusion, the institution that normalized leverage so extreme it cannot unwind, you won't believe the name. And when you see the receipts, the receipt is wilder than you think. Now we stop speculating. Now we stop theorizing. Now we open the machine. Because once you understand how paper silver is created, priced, hedged, and quietly offloaded, you will never look at a spot price the same way again. The financial media uses a comforting phrase, the market sets the price. That is false. In silver, the price is not discovered, it is imposed. And it is imposed in the one place most people never touch, the futures and derivatives complex. Not mine, not refineries, not coin shops. The real silver price is decided in contracts, not metal. Let's simplify this brutally. A futures contract is a promise to deliver silver at a future date. But here's the trick. The seller does not need to own silver. They only need margin, a clearing counterparty, confidence that delivery won't be demanded. That's it. This allows a bank to sell millions of ounces of silver it does not have. This is legal. This is normal. This is the foundation of the fraud. Imagine a stadium with 1,000 seats. Now imagine 100,000 tickets are sold. Why doesn't chaos erupt immediately? Because the organizer knows most people won't show up. Most people will resell. Most people will cash out. As long as attendance stays low, the illusion holds. Silver is the same until people show up. Here is where it becomes parasitic. One futures contract represents 5,000 ounces of silver. Banks stack these contracts like poker chips. Then they layer options on futures, swaps on ETFs, OTC forwards with industrial users, unallocated pool accounts for clients. Each layer creates more claims on the same metal. This is not accidental, it is deliberate, because leverage suppresses price. The more paper supply you create, the cheaper silver appears. And cheaper silver allows more industrial demand, more debt issuance, more monetary illusion. It is the lubricant of the entire fiat system. According to exchange data and independent audits, annual global silver mine supply, 830 million ounces. Annual paper silver volume traded, over 100 billion ounces. Read that again. That is 120x leverage at minimum. Some estimates put it far higher. This is not a market. This is a synthetic construct. Here's where Bank of America re-enters the story. When a hedge fund sells silver short and another hedge fund buys, the exchange clears it. But when a producer hedges output, an ETF promises redemption, an industrial buyer locks supply, a bullion bank guarantees performance, that bank becomes the shock absorber, that bank becomes the insurer, that bank becomes the bag holder if anything breaks. Bank of America sits in that layer quietly, systemically, dangerously. Public filings and OCC data show that. Bank of America's notional derivatives exposure exceeds $40 trillion. Not silver alone, but silver is embedded, interlinked, cross-collateralized. If silver spikes violently, margins explode, counterparties fail, liquidity vanishes. This is not linear risk, it is cascade risk. Most futures contracts never settle in metal. They settle in cash. That's intentional, because delivery is the one thing the system cannot afford. When delivery demand rises, three things happen. Vault inventories shrink, confidence drops, premiums explode. The third signal is the one retail sees, and that signal is screaming right now. At multiple points in recent years, retail silver premiums exceeded 40-70% over spot. That means the price you see is fictional. It means physical silver is already trading in a parallel market. This is the same pattern we saw in 2007 subprime, CDS versus housing prices, 2019 repo crisis, overnight rates versus policy rates, 2020 oil futures collapse, paper versus reality. The paper price lies until it can't. Most investors think, I own silver through an ETF. No, you own a claim. Most silver ETFs operate on an unallocated basis. That means you are a creditor, not an owner. Delivery is restricted. Redemption favors authorized participants. In a crisis, ETFs don't protect you, they protect the system. ETF prospectuses openly state they may suspend redemption during market stress. That's not a bug, that's the escape hatch. And when that hatch is used, the paper price becomes irrelevant. Now we address the number everyone thinks is insane. $109 silver. Let's break it down. If physical silver must clear derivative losses, industrial demand must be rationed, cash settlement must be discouraged, confidence must be temporarily restored, then silver must reprice fast and violently. Not gradually, not politely, violently. Historically, when suppressed assets reset, they overshoot. Gold did it in the 1970s. Oil did it in 2008. Nickel did it in 2022. Silver is smaller, more leveraged, more fragile, which makes the move sharper. Adjusted for inflation and monetary expansion, silver's 1980 high would be well over $400 today. That peak occurred with less industrial demand, lower debt, less leverage, smaller derivatives, markets. Think about that. $309 isn't extreme, it's restrained. Here's the philosophical rot at the center of the system. Losses are socialized, gains are privatized. When silver stays low, banks win, Industry wins, governments win when silver breaks, contracts change, rules adjust, cash replaces metal, trust evaporates. Retail is last, always. This system survived before because, demand was optional, technology was limited, energy was cheap. None of that is true now. Silver is no longer monetary insurance. It is infrastructure. You cannot replace it easily. You cannot recycle it fast. You cannot print it. And derivatives cannot conjure it. Let's summarize the danger zone. Paper leverage extreme, physical inventories tight, industrial demand rising, premiums disconnected, banks signaling stress, delivery clauses looming. This is not a prediction. This is a setup. And setups resolve violently. In the final part, we stop explaining and we warn. Because what comes next isn't just about silver, it's about trust, institutions. And what happens when denial finally fails? We finish this cleanly, powerfully, and memorably. No hype, no soft landing. This is the closing argument. Everything you've heard so far leads to one unavoidable conclusion. This system is not broken, it is exhausted. And there's a critical difference. Broken systems can be repaired. Exhausted systems can only be replaced. Every financial collapse in history followed the same pattern. Excess leverage, suppressed risk, centralized control, public denial. But this time, something is different. Speed. In the past, collapses unfolded over months or years. Today, everything is instant. Capital moves at the speed of light. Algorithms front-run panic. Confidence evaporates in hours, not weeks. When silver breaks, not if, it will not be orderly. There will be. No slow repricing, no polite correction, no warning bell on CNBC. There will be dislocation. Silver is embedded in energy transition, infrastructure, military supply chains, medical systems, semiconductor fabrication, data centers, AI hardware. This means a silver failure is not a niche event. It is a supply chain shock. When silver cannot be sourced, production halts, costs spike, governments intervene, rules change overnight, and when governments intervene, markets stop being markets. Every collapse has a psychological phase. First comes denial. Everything is fine. This is temporary. There's plenty of supply. Premiums don't matter. You are hearing this right now from the same institutions that said subprime was contained, inflation was transitory, banks were well capitalized. Denial is not ignorance, it is self-preservation. Let's return to the moment that started this. Bank of America did not shout. They did not ring an alarm bell. They whispered. That's how insiders speak. $309 silver was not advice. It was disclosure. It was a way of saying, if the system is forced to reconcile with reality, this is the scale of the adjustment. They are not preparing you. They are preparing themselves. Every financial system built on promises instead of assets survives on borrowed time. Paper claims instead of metal. Confidence instead of reserves. Complexity instead of honesty. Borrowed time always runs out. Not because of conspiracy theories, but because of arithmetic. You cannot leverage reality forever. Silver is not the story. Silver is the mirror. It reflects currency debasement, moral hazard, institutional arrogance, the cost of denial. When that mirror cracks, people don't just lose money, they lose trust. And when trust collapses, everything else follows. History is unforgiving but generous with lessons, every time. Elites dismiss warning signals. Paper overwhelms reality. Delivery is replaced with settlement. Rules change mid-game. The outcome is the same. A reset, sometimes quiet, sometimes violent, always irreversible. So now the responsibility shifts, not to banks, not to governments, not to analysts, to you. Because awareness is the only edge left. The system will not warn you again. This was the warning. If this made you uncomfortable, good. That discomfort is clarity breaking through denial. If this changed how you see silver, share this video. If you value conversations that don't insult your intelligence, subscribe. This channel exists to question narratives, not repeat them, to analyze power, not worship it, and to ask the one question history keeps asking us. Are we wiser now, or walking the same path in better suits? Tell me in the comments, and remember, markets don't fail because people panic. They fail because people pretend.